Hi there, everyone. My name is Ned Desmond. I'm here with the SOSV Climate Tech Summit, and I'm very pleased to introduce today our next session, our next breakout session, which comes from Cipher. And the title of this session is Mapping New Clean Tech Across America. Recently passed laws leading with the Inflation Reduction Act are unleashing a historic wave of investments into clean energy technologies across the United States. We're going to hear from some experts on these topics, on this topic and key industries, what they're seeing and what the opportunities and challenges are. And running the session today is Amy Harder from Cipher, the editor of Cipher and founder of Cipher, and I'm sure it's going to be very exciting. Before we get started, I just want to point out that the main area for you to interact with the speakers today is through the Q&A, which you see at the bottom of the screen. So type your questions in there, upvote questions that you really like, and the team will be looking at that periodically during the next hour to see, pick questions that they think would be really interesting to answer. So without any further ado, I'm going to disappear and hand it over to Amy. Thank you for joining us, Amy.
Great. Well, thank you very much, Ned, and the whole SOSV team for including Cipher in this great conference. And of course, thank you to our panelists that we'll hear from in just a few minutes. As Ned said, I'm Amy Harder, founding executive editor of Cipher. I've been covering energy and climate issues for more than a dozen years now, and it's been incredible to see the increased focus on all of these important climate solutions. As Ned said, we're focusing on mapping clean tech across the US, and we're going to hear from a great panel on this conversation. But first, I would like to do a quick sharing of Cipher's Clean Tech Tracker. So I will do a quick share of my screen here. And what we have here is the Cipher Clean Tech Tracker. We launched it at the beginning of the year. Really in response to the Inflation Reduction Act that passed. And what we're looking at here is all projects in certain 5 nascent technologies: carbon management, electrolyzer manufacturing, clean hydrogen production, and sustainable aviation fuel, and critical minerals. So looking at this map, this is everything that's in operation. So not that much, right? So we have a long ways to go to increase what we need to meet our climate goals. And I should say that we're getting this data from the Rhodium Group and MIT's projects called the Clean Investment Monitor. So if you want to dive even deeper into the data, you can. So the next map here I'm showing you, this is everything that's under construction in those areas. A little bit more, but still relatively slim pickings. This is, of course, a static image, but you can go to our website at ciphernews.com for a fully interactive version where you can hover over all of these dots and see the investment dollars, the developers, and more. And when you look through the map and if you don't see a project that you think should be on the map, please reach out to us. We are continually updating the data. Okay, this is all projects, so you can really tell the growth that is underway. Most of these projects are in the announced phase, but still, that's incredible. And all of these projects are eligible for the Inflation Reduction Act. Otherwise, they wouldn't be on the map. And so it's really incredible to see this growth. And we are looking to expand it with additional layers of technologies and continue our reporting on the topic. And I'll get to a couple of examples in a moment. But first, I want to share some of the considerations we've had. And one is how to deal with canceled projects. We all know in the climate tech and climate solutions area, there will be a lot of failures. That's part of the innovation process. And we want to not necessarily normalize it, but to put it into context and help people understand. So we're in the process of determining how best to show canceled projects, because we know not all of these will or even should be developed due to a whole variety of reasons, whether it's finances or community support, can be a lot of reasons. So this really is a very colorful map that shows where we're at with clean tech across the US. In these 5 areas, of course, we're not including all the existing wind and solar farms, which are innumerable and almost too many to count, which is a very good problem to have. As I've mentioned, we do reporting around the tracker. So here are just 2 very quick examples I want to share Here on the left, our DC-based reporter Amina Saeed did a story about how Texas is attracting a lot of the clean hydrogen projects. And we really dug into the data and talked to local experts to understand why that is and some of the concerns that the local communities there have about these projects. On the right, Amina traveled to North Carolina to do a story on a proposed lithium mine site to track the boom in critical minerals development across the US. And our next phase, new layer we're doing in early December will be energy storage. So please be in touch on story ideas you have there and stay tuned. And ultimately, we want the tracker to inform all of the work that you're doing. And so you can go to this QR code to sign up for our coverage and access the map, which we will be constantly updating. So I hope that provided just a very quick overview to set the stage for the conversation that we will be having next. And with that, I would like to introduce my colleague, our rockstar senior science and economics correspondent, Kat Clifford. She joined us earlier this year after launching the climate desk at cnbc.com. Chances are you and or any of the companies you're involved with have been interviewed by Kat over the last several years. So with that, I will hand it over to Kat.
Thank you so much. And what a great introduction. I am going to facilitate the conversation between our fabulous panelists. Let's do a brief round of introductions here. First, we have Alfred Johnson. He's the CEO of Crux, a platform developed to access the liquidity of tax credits within the IRA. Don Lippert is the founding partner of Earthshot Ventures and the CEO of Elemental, a nonprofit investor focused on scaling climate technologies with deep community impact. And finally, we have Riddhima Yadav. She is the vice president at Brookfield Asset Management. So between these three experts, we have a really good broad range of perspectives on the climate tech finance landscape and how the IRA has impacted it. So I'm going to facilitate a conversation for the next half hour or so, but please, if you have questions, be sure to drop them in the chat and we'll get to your questions in a little bit. So, Alfred, I'd like to start with you. You have such a rich background working in the government before launching Crux. So it'd be great if you could give us a bit of political precedent for the tax credits in the IRA, how that came to be. And then also, you've said that the tax credit equity market is projected to go from $7 billion in 2023 to $70 billion by the end of the decade. That's huge. So give us a little perspective about what's driving that growth.
Yeah, so Kat, great question. I think that history is really fundamental to understanding the reality of where we are. The US is not entirely unique, but pretty close to it in our use of the tax code to incentivize energy and manufacturing policy. We do that at a much greater extent in higher volumes than any other countries around the world. Many rely on grants, other investments, domestic ownership, national ownership of things like utilities. And in the US, we use the tax code, among other tools, but with a very predominant focus there. We've been doing that since around 1916 for oil. And again, the history, like very interesting and relevant. So World War I was starting, the costs of oil internationally were starting to go up. The US was aware that we had some capacity for domestic production and started using intangible drilling cost credits or exemptions as a mechanism of incentivizing that domestic production. We then started using similar kinds of credits or started to introduce the use of credits for renewables in 1978. In the 70s, there was the oil crisis. There was similar pressure on energy costs. There was an Energy Tax Act that was passed in 78 that started to employ these credits for the early stages of wind and solar. That was expanded in 1992. It was further expanded in 2005, 2009, and so on. And as we've done that, we've become more dependent as a country on the use of tax credits. Credits are really interesting and powerful as a subsidy mechanism. They allow for the producers of energy, the people that are building projects to get a credit that is proportional to the amount that is produced or the investment that's made into the project. But in most cases, the company that does the building or producing doesn't have the tax liability to be able to consume the credit. So that has always been a problem given our dependence
Can you
on
explain
credits.
what that means? They don't have the tax liability to consume the credit. What does that mean?
Yeah, so I, as the government, give you, a solar developer, $1 of tax credit that you can use to offset $1 that you would otherwise pay the government, which is great if you owe the government $1. But if you only owe the government 50 cents or less, then it's less great, right? And the case with many project developers is that they don't have anywhere near the tax liability to consume the volume of credits that they get through these incentives. That led to the formation of a market called the traditional tax equity market. It was about a $20 billion market up until the passage of the IRA. And in that market, people had to invest in the asset in order to redeem the tax benefits associated because it wasn't previously legal to sell the credits. Now enter the IRA, passed in August of 2022, makes massive use of tax credits. Largest climate law passed by any government ever. About 2/3 of it is tax credits. Congress was looking at the huge volume of credits used for many different categories than had existed before, and looked at the need for those companies to monetize the credits, and saw the existing tax equity market and said that will not be sufficient in order to consume these credits. So created a new structure called transferability, where now those developers, those producers of the energy or the materials can sell their credit for cash. And that market is the market that you referenced in your question. In 2023, about 7 to 9 billion of credits transacted. The volume goes up very materially over the course of the decade. The estimates from Evercore, Goldman, others have the market getting to as high as $100 billion of annual transfers and total credits to be monetized by the time we get to 2030.
Thank you so much for that. I really had no idea that tax credits went back to 1916. So thanks for that. Don, I'd like to ask you how you are helping the founders that you work with get the most out of the IRA, in particular, some of these tax credits, right? Transferability of the equity tax credits is a little bit wonky jargon. Not all tech entrepreneurs may be fluent in finance. So talk to me a little bit about how you work with your entrepreneurs to get the most out of the IRA, the tax credits, and elsewhere.
Yeah, it's a great question. Thanks, Kat. And so good to be here with good friends today. So Elemental, as you said, is a nonprofit investor. We've invested in about 150 companies over the last several years across every vertical in climate, from energy to food and agriculture, mobility, et cetera. I think what I would just share on sort of our approach to the IRA, there are a number of different funding mechanisms within the IRA. There's, of course, tax credits Alfred's been talking about. We've done a lot of work there helping companies access that. There's also a significant amount of grants in the IRA. What I also want to just mention is that there's a green bank that is passed in the IRA, which is one of the pieces of the IRA that people don't know as much about typically. And one of the reasons is that it is to go to nonprofit financial institutions that are new, basically, and haven't really necessarily been investing in the tech ecosystem in the past. So this green bank is called the Greenhouse Gas Reduction Fund. It's about 1/6 of the non-tax dollars within the IRA. And it's really special because the tax credit dollars, the grant dollars in the IRA, they go out one time and are spent one time, and then they are done. These Greenhouse Gas Reduction Fund dollars, so about $27 billion, they are designed to be recycled. So they go into a project as financing. They can be brought in with other bank dollars, other equity dollars, and then they're paid back just like another kind of loan, and they are recycled. So they, as a result, are responsible for a lot of the modeled reductions in the Inflation Reduction Act because the dollars can be put to work again and again. So this is one of the parts of the IRA that we've been spending a lot of time focusing on. Just a few weeks ago, Elemental announced our sort of initial allocation of the Greenhouse Gas Reduction Fund dollars, the $100 million. And those dollars are specifically designed to be pointed toward or focused on entrepreneurs who have market risk, product utilization risk, other kind, credit risk for working in low-income communities, other kinds of risks that make it hard to get financing for their business. And so we're going to be funding our first projects out of that in the next several months. So we can talk a little bit about what that looks like. I guess one thing I'll just sort of zoom out as we're thinking about this with Elemental. One of the ways I like to think about our work at Elemental as a nonprofit investor is to be right on the edge of where other capital might not yet go, and to help build bridges to bring in some of this more scalable capital. So Greenhouse Gas Reduction Fund, it's a great example. Also, several years ago, we launched a policy lab that really helps entrepreneurs figure out how to get IRA and other dollars. So we have we invest both in equity and loans out of Elemental. And so we have a number of different companies that we're working with on development of projects, on their community benefits to ensure that the projects are really serving communities in a durable, long-term way where they're working, to work on how to access sort of tax credits or loan guarantees from the government. And a lot of those companies need working capital or need development capital to access that. So at Elemental, we're providing a range of sort of financial products as well as services to companies to help access and unlock this funding at this very special moment in history.
Just a quick question. When you say and by the way, the Greenhouse Gas Reduction Fund and the IRA, I didn't know about that until we started talking about that before this panel. So, it clearly is a little bit hidden, even for someone like me who spends all of my waking hours thinking and reading about climate tech. When you say it's available for nonprofit financial institutions, what's an example of a nonprofit financial institution? Maybe people don't really know.
Yeah, so the way the Greenhouse Gas Reduction Fund is structured is there's 3 separate programs. One is designed mostly for solar and mostly for states. That's Solar for All. One is designed mostly for community lenders, so like your local kind of community development financial institutions called CDFIs. They haven't been as active in energy and climate funding to date. So this is an opportunity to capitalize those organizations with the mandate to fund greenhouse gas reducing projects. It's pretty exciting to get sort of that entire financial ecosystem pointed toward energy and clean energy and climate. And then the bulk of it, the lion's share of the dollars, are for the National Clean Investment Fund. And there were 3 national awardees to this fund. One is the Coalition for Green Capital, which we're partnering very closely with. Another is called Climate United, which is a partnership of Calvert and several others that put that together. And the third is Rewiring America. And they all have slightly different strategies, but they're all national green banks that have regional green banks and regional efforts that are part of that as well. So what's really interesting, I think, is that this is an effort to capitalize what have been a state-level green bank strategy that's been. Some state green banks are really strong, like NYSEG or New York, Connecticut, Hawaii has a great one. And other states are more nascent in developing green banks. So it's an effort to both do a national strategy around green banks and to support and capitalize on these state green banks that are really close to the challenges that they are seeing on the ground, and are able to move capital into some of these projects. So those are essentially the awardees. Those were all announced in April of this year. The dollars were obligated over the last couple of months, and are now in the first stages of being rolled out from those institutions. So it really did take, almost 2 years for the competitive process to play out and for all this to get set up. And now we're really going to start seeing dollars hit projects and hit the streets.
Wonderful. Thanks so much. Riddhima, I want to turn to you. I think more than anyone else in this panel, you really have an international vantage point in your work. So I'm curious to hear from you a little bit about what do you see as international markets? What are they how are they viewing the IRA? And also, everybody here knows we have a big election in a few weeks. And so I'm curious to get your perspective on how other international markets are expecting and preparing for potential changes to the IRA, depending on what happens in November.
Thanks, Kat. And firstly, thanks everyone for being here, and thank you for having me. A couple of points I'd make in relation to the international and global impact of the IRA, which arguably, even though I am biased, is somewhat more magnified than the impact in the US. And the way that we think about it, is using a framework that we often refer to at Brookfield called the 3Ds, essentially deglobalization, decarbonization, and digitalization, which are the three secular trends which are in some ways pretty immune to the cyclical trends that we see both in markets but also in politics. And I think these are things that continue to remain pretty sort of consistent across the ups or the ebbs and flows of government policy, etc. In terms of the impact of the IRA, I would argue the following. One is suddenly governments around the world took attention and woke up and said, well, we need to start thinking about what this means for the competitiveness of our own industries. And suddenly carbon became a vector of economic competitiveness, which governments had not been thinking about it in that way. They had not linked the decarbonization aspect so directly to industrial policy. So in some ways, the IRA in the US resuscitated the an advent of like industrial and the concept of industrial policy in many different countries. And Europe, in fact, was pretty proactive, starting with feeling very happy about seeing the ambition in climate, but then quickly realizing that they have a competitiveness issue in hand, which saw the response in terms of the Net Zero Industry Act. The second thing I'll mention is in terms of the supply chains for corporates, the IRA has obviously made a tremendous impact to the competitiveness of more of the frontier technologies. But in terms of the impact it has for countries that are looking at supply chains across different parts of the world, the question is really how will I be ultimately enabled, how will I ultimately be able to get the technology transferred? And what are the implications of that? Any country, for instance, thinking about emerging markets and some of the other sort of regions in the world in the global south is immediately going to start thinking about what are the cost implications for me to bring that technology from the US if that technology will be scaled up in the US as a result of the IRA. And the third thing I'll just mention as it relates to the impact of the election per se is a lot of this is already baked into what people are forecasting. So the market loves certainty, investors love certainty. And so I think knowing that there are aspects of it which will continue to remain pretty sort of stable on the IRA is really important. I think all of us have a rough sense of what those are and which ones are perhaps in danger of being repealed. And so I think having that certainty.
I'd love to hear your perspective on which ones of those you find particularly certain and which you feel are more vulnerable.
Yeah, I mean, I think partly the industry around clean energy and renewables is pretty strong without, even without the IRA, it was cost curves are coming down, etc. There are certain industries, like in the case of mobility, that you need a little bit of stimulus on the side to incentivize consumers, etc., for uptake. That might be, somewhat threatened in terms of how the IRA might shape up after the election. So I think knowing that a lot of the commitments and the investments from the IRA are targeted towards Republican states somewhat is a consolation factor. And also knowing that a lot of it is already being flown in and being seen in terms of investments in projects, et cetera, will help sort of compress any negative sort of repercussions as it relates to the pullback. But the TLDR is that most of these technologies, at least in the on the later stage side, which is where we spend a lot of our time, are seeing an incredible secular trend as a result of the three forces I mentioned, which will withstand political implications. And so that's the message that it's companies and the private sector that's really driving this transition.
Alfred, I'd like to bring it back around to you. One of the things that Riddhima mentioned is that businesses love certainty. And so I'm wondering, how do you, recognizing that there is some certainty, some of these tax credits, there's more confidence that they will stay around, and others there's less confidence. But what do you think are the implications of this kind of uncertainty on the market from your perspective? And I'd also wonder if you have any thoughts on, another thing that Riddhima mentioned is that a lot of the benefits of the IRA are going to red states. And I wonder if you have any thoughts about why that is.
Yeah, so I'm going to build on Riddhima's very strong points there with 4 points. One is the credits have been used for years. Two is the IRA is current law. Three, energy costs and demand are rising. And four, follow the money. So quickly on that, as I mentioned, credits have been a part of the U.S. policy mix for decades. They've been extended and expanded by every conceivable mix of the House, Senate, and the presidency, including under Donald Trump. So there is good track record of them being extended. The IRA, by construction, gave a lot of certainty. So it was put in place, and many of the credits were put in place for 10 years, so until 2032, or until we get to 25% of 2022 GHG emissions levels. So any new Congress and president that would seek to change the law would have to repeal the IRA or parts of it, as opposed to allow it to lapse, which is often the chosen mechanism when people want tax policy to change. Congress will just not renew a piece of legislation. This legislation is the law, and so would need to be changed. Three, energy costs and demand is rising. There's been a lot of ink that has been spilled on it for very good reason. We're seeing demand growth rise for the first time in more than a decade. That's coming from AI, data centers, other sources. That is flowing through into the capacity auctions, the costs of energy, which I think sets a very interesting backdrop where, again, if anybody were to try to repeal the IRA, they would be directly increasing the cost of energy in a way that would flow through into communities across the country. And then fourth, to Riddhima's point, follow the money. The money has disproportionately been going to red states and rural areas, in part because that is disproportionately where there's land to build these kinds of facilities. It's where the sun shines and the wind blows in greater proportions. The US sort of chattering class in DC has spent a lot of time saying that, observing that, but members of Congress are now saying it out loud. So there were 18 Republicans who wrote a letter to Speaker Johnson over the summer saying these credits are very useful, don't take them away. Speaker Johnson was recently asked whether he would repeal the IRA, and he said, if we do anything there, we'll use a scalpel as opposed to a sledgehammer. And don't take my word for it. In pricing, we're seeing right now very positive impacts in the market where people are looking at 2025, 2026 credits and broadly pricing in the market is healthy, suggesting that investors that are putting their money on the line believe that the credits will be around for at least the foreseeable future.
John, I'd love to ask you, you mentioned the greenhouse gas reduction fund in the IRA, which I'm really glad you brought up. But I also love to hear, are the founders that you're working with, are they accessing the tax credit equity markets that Alfred is talking about? And what is your perspective on sort of the potential uncertainty we may see in with the election in November? What are you hearing from your founders?
Yeah, I think Alfred covered that really well. I think what I would say about the tax credit piece as it relates to our founders is that one of the things that's become clear with the IRA is that there are tax credits for fully commercial technologies and tax credits for emerging technologies. But we would like to see more support for emerging technologies in the IRA. It's much easier to sell credits for commercial technologies. And, Alfred and I, and actually Riddhima and I have had conversations about sort of what's needed to commercialize the vast numbers of technologies that have now been invented specifically over the last 5 or 7 years. It's been a really ripe time for innovation in technology. This is the sort of confluence of a number of different things. One is that in 2018, when the skies turned orange over California, we just saw a flood of talent from founders into climate, from tech and other kinds of businesses in a way that was really unprecedented in the 15 years that I've been investing in this space. Two, with what's happening in sort of machine learning and AI, there's just been a real acceleration of innovation broadly, and a lot of that has been applied to climate. So what we're seeing is just this real wave of innovation and climate companies. There's also much more venture capital in the space than when I started. We're averaging $50-60 billion a year in venture capital going to climate now. That's more than 10x when I started investing in this space, and really strong investors in the space now. So we're seeing a lot of early stage ecosystem movement and a lot of support at the early stages for technologies. And then I was recently talking to one of the large investors in our space, and he said the biggest task we have is the need to build the first of a kind and push through to nth of a kind plants. And so I think what I'm really thinking about, and what we're noticing as IRA has begun to flow through, is that there actually isn't that much support in the IRA for first of a kind plants to early of a kind plants. And we need really specific structures and catalytic capital and other kinds of things to really unlock that. What we're seeing in the portfolio is that innovation in technology is outpacing some of the innovation in finance, innovation in policy that's needed to sort of move at the speed of technology. So one example is a geothermal company we've invested in. They now have hit very low cost numbers, decades earlier than sort of what DOE reports would sort of suggest or predict. But now it's really about the cost of capital and permitting and making sure that these other kinds of financing and policy structures are catching up to where technology is. And we're sort of just now seeing that kind of across the board, that the speed of deployment and the speed of customers moving, the speed of financial tools to sort of meet this need has not kept up with technology. So that's where we're spending a lot of time as Elemental. We're thinking about, we recently introduced a new product into the space called Development Safe, which essentially is like a, Y Combinator, very popular financial instrument called a SAFE, a simple agreement for future equity, very low transaction cost, very low friction. We haven't had something like that for project finance. So we introduced a Development Safe, which kind of acts like a synthetic development loan, very low friction way to get development dollars to companies so they can develop projects, get to their next milestones, and investors like Brookfield and others can come in with some more confidence as these technologies are de-risked and the projects are de-risked. So we're thinking a lot about ways to use financial instruments to help companies access IRA dollars, but IRA, so government, I would say philanthropy, commercial dollars, really all across the board to unlock this, which we're seeing as increasingly a real existential issue in climate technology. All of these companies that have been started, all of this technology that's working, but that's running at a brick wall of financing challenges.
I definitely want to pick up more on that point, but just to our audience members, if anyone has questions, we aren't getting a ton of questions from the audience, so please don't be shy. Submit your questions. Let us know what you'd like to ask. But then I do want to get back to that point, and Riddhima, I was going to turn to you. This valley of death, right? I mean, it's such a hard place for startups of any kind, but in particular the climate startups that we're talking about, and it's where a lot of the market is right now, going from getting venture funding, getting from lab scale, to a pilot plant, but then getting funding to scale up and to get past that pilot plant is such a hard challenge. Do you have any advice for founders, or what are you seeing from your perspective?
Yeah, no, absolutely. And it's very topical. In fact, Dawn and I were talking about this just a few weeks ago, and just seeing how we can sort of, across the spectrum of capital providers, really bring everyone together. So I'd highlight a few things which a lot of people should think about. Some of which may not be new, but is in some ways still a challenge for climate tech startups. From our perspective, what's really, really imperative is where is the demand coming from? It's not just your ability to actually supply, but who is actually going to be the off-taker for your product or service, and how much are they willing to pay for it? So in this case, whether it's the corporate or whether it's the end user, that is a very crucial element for the financing or the economics for an investor like us. Number two is you need to think very creatively about the capital stack. And something that's very unique about Brookfield is the ability to provide structured solutions where our capital can not only just go at the top co, but can also go in at the project level itself. And so that flexibility across the capital stack is a lifeline to many climate tech startups, because they may not want to, raise that quantum of capital at the top co, but they certainly have those needs at the project level. And so versus bringing together 10 different investors to provide those different parts of the capital stack, it's incredibly efficient to have the ability to do that with a handful of very strategic investors who have the creativity and the flexibility to provide that sort of capital. And the third point I'll just mention, I think Dawn has done incredible work in this space, is last year in some ways, this past year, in fact, and really starting from also what we saw at COP28 was the incredible impact that catalytic capital can have in terms of incentivizing investments into areas or sectors, or even for that matter, geographies, which are inhibited by the lack of private capital. We've seen that in the case of Altera, which was pledged by the COP28 presidency in terms of providing catalytic capital for the global south. We're seeing a similar principle in the UK as of Monday of this week, where the National Wealth Fund is going to provide catalytic capital to kickstart industrial decarbonization in certain strategic sectors for the UK economy. So I'm really seeing that that concept come up pretty heavily across different countries and different geographies, and that can actually become a very key sort of ingredient for many startups as they go on to the phase where they're ready for Dawn to us.
Alfred, how do you see the availability of the equity tax credit market impacting that capital stack, that availability of all kinds of financing? What do you observe there?
It's a great question, Kat. So when you think about your typical development project in the United States, and here abstracting away from technology, you might have something like 30% of the capital stack coming in the form of tax credit that needs to be monetized. The rest of the capital stack would be composed of debt and equity. So in your indicative slices, you'd have 30% tax credit, something like 60% debt, something like 10% equity. The interesting thing about the transferable tax credits is they change the way that the rest of the capital stack forms. So we're starting to see the tax credit be more broadly used as a form of collateral, as the mechanism by which the earlier stage financing is taken out and refinanced. And I think that provides a really interesting opportunity with first of a kind to nth of a kind technologies, particularly as we make the transition, which we will make in 2025, from these categorical tax credits associated with specific technologies into a tech neutral tax credit regime, where going forward, there will be just general credits that are available for the production or investment in clean electricity, for example. And that provides even broader subsidy to categories that weren't necessarily predefined within the IRA. And as a result of that, those kinds of facilities that will be coming online in the back half of the decade that may have a corresponding investment tax credit that is expected to be earned when the CapEx is made into the project, that company, that development may be able to use that credit as a mechanism of gathering earlier financing against the project. So there's a lot of innovation that's happening here. We are very actively working with developers and manufacturers to help them pull forward the cash receivable associated with the tax credit through various forms of financing. So this is a place of very, very intentional innovation.
Is it happening? Is it working? Is when a company has a significant amount of tax equity, does that help them get financing for moving through this valley of death?
Yes. So the market is in general working better, and pricing on tax credits is higher in more established categories. So utility scale, wind, solar, battery storage has better access to the tax credit market than much smaller, much newer technology types. But the story here is decidedly positive. So if you imagine that the largest utility scale solar tax credit might trade at 95 cents on the dollar, the smallest might trade in the 80s, right? And a $5 million project might trade in the low 90s. And that needs to be held up against what the market used to be for only traditional tax equity being the mechanism by which those credits would be monetized, where smaller developers and novel technologies did not have access to capital in anywhere near the way that they do now. And so that the market is getting much more democratized by virtue of having this access to capital through the tax credit. It's also unlocking other forms of earlier capital and bridge financing. So there's a lot of money that is flowing into projects and different projects that would have gotten it before as a result of this policy.
This is
You have one thought there, Kat, which is that I think that also with some of these tax credits, like the devil really is in the details. As we've been funding some of the development loans into projects, one of the things that we're seeing is that, for example, if you're doing an apprenticeship program and that's a way that you're capturing more tax credits, the actual detail of how companies roll that out and document it is really critical to capturing tax credits. And you can get up to the 80s. But if you don't have that, it's actually, you could be way, way, way low in terms of what you can monetize from those tax credits. So there's a lot of work that actually needs to go into preparing companies to do this well. I would say especially emerging companies. And it's one of the places where early on in this sort of like work around climate, I would say philanthropy really funded a lot of R&D and early stage stuff and wanted to sort of like seed new ideas and professors and innovation and invention. And now what we're seeing is philanthropy really moving into this gap and realizing what the challenges are here. And one of the ways that we've been, in particular, deploying philanthropy around this is a huge amount of coaching around policy coaching, we're actually dropping developers and residents, fractional CFOs into companies to do this work at a very detailed level. So they've done it for one company, they do it for other companies. We don't all have to like learn the same thing in sequence year after year after year, but how can we be much more efficient there? And we're also doing the same thing for dropping folks in on community engagement so that we're actually learning much faster in terms of how to engage communities. We're trying to make a very fast energy transition, and those kinds of things that create disruption, and they create opportunity to bring communities along and for communities to invite technologies in when they see the benefits. So it's not just about sort of like fighting or ensuring that your products are not being fought by communities, but how do you sort of create invitation and take it one step further? So those are some of the things that we're using philanthropy to fund right now. And I think that those sort of like services and like technical services around this are so critical to making these markets work well.
I was going to ask for a few of those best practices to, if you wanted to share for founders, some of those best practices to ensure that founders can get the most out of these benefits.
Yeah, go ahead.
You want to start? I'm happy to layer in.
Go ahead.
So in general, I think Dawn is exactly right that when you're starting one of these businesses or building in a new category, really understanding how the credits work is fundamental. And you need to understand that early in the life cycle of the project or company, because the credits may be a very material source of capital to your company. So I think education is the first step. As you start to get closer to realizing the tax credit or gathering a forward commitment on your tax credit, really being prepared to answer the questions that investors and later the IRS may have about how you calculated the credit, what substantiates it, what adders are you eligible for, and the law provides for additional credit based on whether the project is in an energy community or uses domestic content, or to Dawn's point, you're having you're adhering to the prevailing wage and apprenticeship standards that provide for more tax credit. So there's quite a lot of preparation that people need to do, founders need to do when they're accessing the market. The good news is there are great people that know this market really well, Elemental at the front of that list, but also law firms and tax advisors and other experts in the field. Crux is doing quite a lot of market education on the space, including things like building standard diligence checklists that people should be prepared to have ready when they go through a transaction process, building that into the product, building things like our data into the product such that sellers and buyers have an easier time aligning on price, and really trying to bring transparency so that all the parties in the transaction are able to transact as efficiently as possible. But I don't in any way mean to understate the sophistication and the complexity of doing this. We are trying as a country to do a lot through the tax code, right? We are trying to do industrial manufacturing policy. We're trying to do labor policy. We're trying to make sure that there's investment in, retired coal plant census tracts. Like we're doing a lot. And the result of that is complexity that the sellers of those credits have to manage. And the good news is if they manage it and the resources are there, you get quite a lot of capital associated with the credits. And that's driving a lot of investment across the country.
Seems like founders could really use a playbook for all of this. Yeah, there's a lot of complexity there. Thank you so much. I'm going to hand it over to Amy. She is going to facilitate a few questions from the audience.
Yeah, great. Thank you, Kat, and such a great conversation. I really loved hearing from all of you. And thank you to the audience for becoming unshy and dropping in some questions. Always excited to see that. I'm going to do the first two in a batch. I do think we sort of addressed the question from Arzu Sharma about the election, but if anybody has any additional comments to make about that, in particular, the impact on the tax credit market, maybe Alfred, if there's anything more you wanted to say on that in terms of broad uncertainty. I think we're already seeing a slowdown in investments, which I think some have attributed at least partially to the election. So any additional thoughts there? And the next question from Alicia Yana is, what emerging technologies or innovations in the climate tech space do you think hold the most promise for accelerating progress toward net zero? Maybe Don or Riddhima could take that question.
Cool. Happy to quickly respond on the election. I think one of the other things I didn't say in my earlier answer is just how broadly distributed the credits are categorically, right? Like we've spent a lot of time talking about wind, solar storage, but you also get credits for nuclear and carbon capture and hydrogen, which, as you pointed out, Amy, is disproportionately being invested in Texas. And so the result of that is that there are constituencies for all of the different technology areas that are not evenly distributed across the United States, right? There you see advocacy for things like battery manufacturing in Georgia because there's been so much investment that has gone into the state. You see advocacy for carbon capture from oil and gas companies and from Texas. And what that means is that when you start to configure all of the different parts of the Republican caucus and say, who is benefiting from this? Who cares about what? Again, it's hard to holistically pull it out root and branch when there are different parts of the caucus that care about different things.
I can come in on the second question, Amy. I think in terms of the question on emerging technologies, I have a little bit of a anticlimactic answer because it's not emerging. I'd say nuclear is something that I would keep my eyes on because we definitely expect it to play, if all goes well, a continuing to a larger and larger share. And we're seeing that incredibly, that incredible momentum with some of the tech players driven by a lot of the data center demand. We're seeing dime a dozen announcements every week from the data center developers and aggregators. And so I think that's going to be a big one. And just to give one data point around it, not specifically nuclear, but the importance of power and the importance of reliability of power for data centers. Some analysis that I recently came across sort of was saying that even if developers can get a grid interconnection 2 years faster than they would otherwise have gotten, they would be willing to pay 100% premium on the power price for that data center. So that's how much economic sort of impact the whole regulatory environment and how clean and green and reliable the power is for some of these data centers is going to drive the uptake of certain energy technologies.
Yeah, I think that's a really critical point, and we're seeing that really across energy right now. It's funny, I think a lot of us that sort of were educated at 15 years ago in this space or 10 years ago or came up in energy, we grew up in a world where load was sort of always flat or kind of declining, and we had energy efficiency in California and more productivity, less energy use. So that's sort of the framework in which a lot of, I think, folks are sort of used to. And this is such a different world now, and it really is important for innovation that can now move in and like sort of be drawn forward with this new energy demand. It's a totally different market environment than it was even 5 years ago. I would say some of the other technologies that we're really interested in. I mean, we think of climate, again, not as like technology areas, but really just as a theme across every single sector of the economy. There's a lot happening in a number of these sectors. And I think to Riddhima's point, some of the places where we're really excited about new technologies are places where we're seeing demand and big companies, big customers move with their dollars and their commitments in terms of demand. So we're seeing some really interesting things around that in regenerative agriculture and food. We invest in a company called Clim that's really sort of, it's very active in Europe and is taking advantage of the demand from CPG and other companies to really know what's in their supply chain and how to decarbonize it. We're very interested in industrial decarbonization. So steel, cement, concrete. Again, we're seeing a lot of announcements on that and creative ways to be buyers of those commodities, which have to be decarbonized and account for up to 30% of the emissions in the US. We're also very interested in sustainable aviation fuel. We made an investment in a company called Dimensional that's building a couple of plants, one in upstate New York that we provide development capital for in collaboration with Seneca Nation. And we really like the model there of not only community partnership, but actually equity ownership in a plant. I think this is really where a lot of this stuff is going, and it's very exciting to see them doing that. And then finally, another area we're really interested in is just some of the building blocks for the transition. So I continue to think there's a lot of innovation happening in critical minerals. We've made a number of investments in that space, from cobalt metals using AI to much more efficiently identify and develop resources, to Nth Cycle, which is a company that's uses a much cleaner way to recycle critical minerals from existing sort of batteries and other things, to a company called Mold that has robotic arms to disassemble, giant servers from data centers, which are not only being built, but then being like replaced at a really extraordinary rate. Sometimes, servers are only in service for like a handful of years before they're replaced. So I'm really thinking about not only sort of like the first order effects of some of these transformations, but then what's happening on the back end. How do we recover some of those materials in a way that enables us to also not just continue to have greater and greater toxic waste dumps and water streams across our country, and particularly other countries where we're shipping a lot of this waste.
Yeah, thanks for that, Don. And I think it's a reminder of the other, all of the additional environmental concerns and hazards we have to be contending with, not just climate emissions. And so that's a good segue to a batch of the next two questions. The first one is from Mark Grossman. Are there any financial innovations that any of you wish would magically appear that you think would help increase investment in clean energy projects? So it's a chance to be a little bit magical with our thinking. And then the next question about other environmental issues. Madhav Verma asks, how are these financial innovations supporting startups that are endeavored to create innovation directly contributing to the United Nations Sustainability Development Goals, SDGs? Number 6, clean water. Number 3, health and hygiene. And number 14, life below water. So maybe Riddhima or Alfred, you could attack the first question, and maybe Don the other one.
Yeah. Do you want to go ahead, Alfred?
Go ahead. I'll follow you.
Okay. Well, my wish list is first loss capital. And I think that's not so much a financial innovation per se, but it's a scarcity in capital markets right now in terms of pools of capital that are willing to serve as downside risk protection. And so I think that's something that I think Dawn recognizes as some other attendees might realize is traditionally the foray of very small pools and trickles from grants so I think we need to scale that to a lot more. It can come from a mix of philanthropy. It can come from a mix of other sort of public sector institutions, etc. But I think that's one thing that can have a really catalytic impact on scaling investments.
Yeah, I think that's a great point. Adding to it, I think it's always interesting when you're operating in a new market, because you end up relearning things that we know from other markets. And in the energy market in general, we have long operated on the observation that when power is committed, when offtake is committed, the project becomes significantly more financeable. And the same is true for other attributes that the project may be selling. And so one thing that we're very actively developing right now in the tax credit market is a deeper bid for future tax credits. So companies that are willing to commit to purchase 2025, 26, 27 tax credits, because if we can build a liquid market there, and it's getting better, but when we build it, you start to stabilize offtake at a given price from a buyer, and that dramatically lowers the cost of capital on other kinds of financing, the bridge and construction lending. So my wish is that that market becomes really robust and liquid, and we're doing our best to make it that.
Yeah, I think that's a great point, Alfred. And I would just add that I think one of the things around offtake that would be really interesting to see in sort of magic wand space is a way to commit to some of these future, whether it's tax credits in your case, Alfred, or sort of future gallons of fuel or power in a way that is strong enough to gather financing and to get financing to back it, but is also not so problematic that's creating real liabilities on the balance sheets of the companies that are doing that, because it just really limits the number of companies that will do this to like sort of a very small handful of tech companies. But if you're talking to like transportation companies, logistics companies, airlines, a bunch of these other companies, it's just not really doable. So I think this is an area where we're spending a lot of time sort of thinking about what's really financeable and how do you align those incentives and thread the needle for offtake. And then I think the other one that we're really interested in is similar to what Riddhima is saying around first loss capital, but I think there's a lot of kinds of capital that are available in other industries and totally normal. Like in real estate, you can get a development loan any day of the week for a project. I mean, it's a very well understood market. For almost every technology that we're financing in climate across each of these themes, you really can't get development capital. There's just not a sort of a market to do that. I mean, you used to not even really be able to get it for solar projects. I mean, now we can, that's sort of unlocked. But like, I think what we are thinking about is how do you take some of these same tools that we have in other markets and that enable investment, predictability, and infrastructure investment, and move them into climate faster. And so there's certainly a role for catalytic capital in helping de-risk that and helping people come in, helping people get comfortable and sort of like do the first several loans, develop a diversified enough portfolio to be able to do that. So those are the kinds of things that we're spending a lot of time thinking about right now at Elemental.
That's great. I do think we're almost at time. I do see lots of great questions in the chat though. So I'm going to kind of lump some of these into one question. I see a lot of questions about folk finance and the hurdles facing that and the best lenders for that. So maybe not to take the thunder from Kat, but maybe if we can make concluding comments from each of you, your thoughts. And I know we've covered this already, but it's clearly a hot topic for the audience. So we can end on that. What are the challenges you see in folk finance, and who are the best lenders, and maybe just kind of go down the list for each of you to get your takes on that. Riddhima, why don't we start with you on that?
Sure. I think three challenges. One is a creativity in the capital stack, like I said. Two is the ability to get an offtake upfront, so breaking that offtake chicken and egg situation. And third is the ability to basically, we often forget it's ultimately about execution. Like you actually have to build the project, and a lot of people don't know how to do that. They think they know how to do it, but they don't know how to do it. So I think execution capabilities are incredibly important. So those three are like important ingredients for folk.
Yeah, I would say really, really similar. For us, we've broken it down into three particular pieces that we think are necessary for folk. One is catalytic capital and bringing in other kinds of capital. So again, I would say philanthropy is important. Government's really important here too, and there's a role for government. And so catalytic capital is number one. The second, exactly to Riddhima's point, project expertise is critical around execution. And we can learn a lot from other industries. We're starting to see some of that expertise come in. But we have a lot of building to do, like really unprecedented level of building. And some of the stuff we're building is quite complicated. But other stuff we've built before, and it's just a new component to it. So I think we're thinking a lot about how to sort of parse out those risks. What are the pieces we've built before? What are the new pieces? And can we like sort of make some progress in financing by thinking about it that way? And then third is community partnership. We think this is critical to getting any projects done.
Great, thanks. Alfred, I might chime in and ask you to, I see a question in the chat that's getting 3 thumbs up. That's directed to you. So maybe if you want to add that, it says, given the tax credit transferability is a relatively new thing, how should or will it be regulated? And what is the role of the IRS and the auditing Big Four and larger exchanges? I know there's a lot in there, but if you just want to touch on that topic along with folk finance, that'd be great.
Yeah, so I think on folk finance quickly, the market for tax credits has become quite vibrant on the basis of the financial characteristics of the credit alone, right? Like it hasn't needed the sustainability characteristics of the credit to drive the adoption of the market on the buy side. But that doesn't mean that that couldn't be taken into broader account for folk. And we've seen demand signal in other categories like carbon offsets coming from companies that are stabilizing the offtake on that product by giving a forward commitment on it. I think you could see the same thing on the tax credit, where there would be a commitment to take it from a company that really cares about the technology. And interestingly, on the credit, they wouldn't have to come out of pocket in order to do that. They would just give the commitment by virtue of giving the commitment. You stabilize the offtake and you improve the cost of capital. And then lastly, on transferability, it benefits from the fact that the statute underlies the market, right? So unlike other environmental commodities, for example, like the voluntary carbon market, where there's some question on standards, the government has said what the rules of the road are in the statute. It's been further stabilized with guidance from the Treasury Department, and that provides a really strong foundation. The IRS is already the effective regulator on that.
We're out of time, but I just want to say thank you to all of our panelists. As everyone has articulated, we're at a really critical point in climate innovation and climate tech. We've got a lot of innovation, and now it's time to build and finance, and how those projects are going to get financed is really important. So thank you to everyone for being part of this conversation. And that's a wrap on this panel.
Thanks for having us. Bye, everybody.
Thank you.
Thank you.